In July of 2025, a company that had existed for roughly 6 months, that had no product, no customers, and nothing you could actually buy, raised $2 billion. It was the largest seed round in the history of the technology industry. The company was called Thinking Machines Lab, and it was founded by Mira Murati, who had until recently been the Chief Technology Officer of OpenAI. The pitch was the people. Murati brought a wave of senior researchers out of OpenAI with her, and investors decided that was enough. They valued the company at $12 billion before it had shipped anything at all. 4 months later, the company went back out to raise again, and this time the number being discussed was $50 billion, a fourfold jump in the space of a single season for a company that still had almost nothing to show anyone. And this time, the money stopped. By January, the talks had collapsed. 3 of the founding researchers quietly went back to OpenAI, and the company stayed frozen at its old valuation with the same empty shelf it started with. This time, the investors looked at the numbers and quietly backed away. And that moment tells you almost everything about where the industry is right now, because the entire AI business is running on numbers that only hold together as long as nobody looks too closely. So if these companies are burning cash faster than any business in history, what exactly is keeping them alive? To understand the answer, you have to start with how much these companies are actually losing, because the numbers underneath the AI boom are unlike anything the technology industry has produced before. Take the company at the very center of it. In 2025, OpenAI booked around $13 billion in revenue, but leaked financials put its costs for the year at about $34 billion. That works out to an operating loss of nearly $21 billion and a net loss of $38.5 billion in a single year. To put that in scale, OpenAI lost almost $3 for every $1 it managed to bring in. Its own internal projections have the cash burn climbing to $25 billion this year and $57 billion the year after that. Across the rest of the decade, the company expects to burn through $665 billion before it turns cash flow positive, which it does not expect to happen until 2030. Now, the standard defense is that this is just what it costs to build the future, and that the profits come later once everyone is hooked. The problem is that the economics do not actually improve at scale the way they are supposed to. For a traditional software company, this is where the magic normally happens. You build the product once, and every new customer after that is almost pure profit. Gross margins of 80 to 90% are normal, but AI does not work like that. Every single time someone uses the product, the company has to pay for the computing power to generate the answer. According to leaked figures from Microsoft's revenue sharing arrangement, OpenAI was spending roughly $2 on computing for every $1 it earned back on that usage. So the more popular the product gets, the more money the company loses. That is the exact opposite of how software is supposed to behave. And across the industry, for companies built entirely around AI, computing costs eat up somewhere between 30 and 60% of everything they earn. For a traditional software company, that figure is 5 to 15. This is the thing the founders do not want you to look at too closely, and it explains a pattern you have probably noticed without quite naming it, because whenever the losses come up, the conversation somehow always drifts towards something much bigger and much further away. For example, in January of 2025, Sam Altman published a blog post declaring that OpenAI was now confident it knew how to build artificial general intelligence. 7 months later, an interviewer asked him where GPT-5 sat on the path to AGI. Altman never answered. He asked the interviewer to define AGI first, then admitted he had several definitions himself and that it was not a super useful term anyway. In the end, his position was that it doesn't really matter. One analyst at the research firm Futurum told CNBC that AGI is a bit of a distraction promoted by those who need to keep raising astonishing amounts of funding. The promise of a godlike machine tomorrow is a very effective way to stop people from asking about the losses today. Altman himself has admitted that even the $200 a month premium subscription loses the company money. So if the core business loses money on every customer and the profits are always a few years over the horizon, the obvious question is where the cash to survive keeps coming from. And this is where the story gets genuinely strange. A large part of it comes from the very companies these startups are paying. The chip maker Nvidia announced it would invest up to $100 billion into OpenAI. But OpenAI then turns around and spends much of that money buying and renting Nvidia's chips. The research firm New Street estimated that for every $10 billion Nvidia puts into OpenAI, it gets back around $35 billion in chip purchases. OpenAI's own chief financial officer said Nvidia puts in some equity to get things jump-started, but importantly, they get paid for all those chips as the chips get deployed. So the money goes out from the chip maker and comes straight back to it. Analysts at Bernstein and Seaport have compared this directly to the round-tripping schemes that inflated the dot-com bubble, where companies invested in each other to manufacture the appearance of demand that was not really there. And this brings us to the accounting. Because when a business loses money on every sale, it has to get creative about how it presents itself to the next investor. The first trick is cloud credits. When Microsoft, Amazon, or Google invest in an AI startup, a large share of that investment does not arrive as cash. It arrives as credits that can only be spent on that same company's cloud computing service. Often, a startup will burn through one provider's credits, then move on to the next, and then the next, delaying the moment when the true cost of computing actually hits its financial statements. The second trick is the numbers themselves. According to reporting from TechCrunch, many of these startups have started quoting a figure called committed annual recurring revenue. It sounds like real revenue, but it includes contracts that have been signed and not yet delivered, and sometimes money that may never actually arrive. Investors told TechCrunch that at least one well-known startup claimed to have crossed $100 million in recurring revenue, when only a fraction of that came from customers who were actually paying. The deeper problem is that these companies cannot simply stop spending to save themselves. To get access to enough chips, startups sign long-term contracts that commit them to paying for computing power for years, whether they use it or not. And the firms renting out that computing power are trapped just as badly. Companies like CoreWeave are sitting on a backlog of contracts worth nearly $100 billion, financed by around $25 billion of debt. The catch is the timing. The repayments on a large chunk of that debt began in January of this year, at interest rates around 11%. And they began at exactly the moment the rental price of the chips backing all that debt had fallen by 50 to 70%. The value of what they own is dropping while the bills on what they owe are coming due, which is what investors call the GPU debt treadmill. And when a startup finally cannot keep running on the treadmill, it rarely collapses outright. More often, it just gets absorbed into one of the giants. Over the past 2 years, big tech has spent more than $20 billion hiring away the founders and core teams of AI startups without ever buying them and leaving the companies themselves to rot. Microsoft did this with a company called Inflection. Amazon did it with Adept. Google did it with Character AI. Meta paid more than $14 billion for a large stake in a company called Scale, and 1 month later, Scale laid off 14% of its staff. The founders land softly inside a $1 trillion company. The technology gets licensed away, and the ordinary employees and smaller investors are left holding shares in a business that no longer does anything. All of this only works as long as the money keeps flowing in to cover the losses, and there are now serious warnings that the flow is about to reverse. Morgan Stanley estimated it that building all the planned AI data centers through 2028 would require close to $3 trillion, and that the industry faces a financing gap of around $1.5 trillion that nobody has yet figured out how to fill. To cover it, the biggest tech companies have been borrowing at a pace never seen before. In just the first 5 months of this year, 5 of them issued $159 billion in bonds, which was more than they had borrowed in the previous 5 years combined. Recently, the Bank for International Settlements compared the artificial intelligence boom to the canal mania of the 1800s and the dot-com crash. The International Monetary Fund warned about a dangerous mismatch between short-term debt and long-term bets, and 4 United States senators wrote to regulators asking them to investigate what they called complex and opaque debt markets forming around AI. This is a financial structure built on the assumption that the losses can be outrun forever, funded by money that increasingly turns out to be borrowed, recycled, or simply invented. But for now, the machine keeps running. The valuations keep climbing, the funding rounds keep closing, and everyone keeps agreeing not to look too hard at the gap between what these companies earn and what they spend, because at this point, the lies are no longer really being told by the founders. They are being kept alive by everyone who cannot afford to stop believing them.